Hi everybody, welcome back to another video. So in this video, we'll go through the full year 2022 of Keppel DC Reit's earning results, and from there we'll analyze on what are the pros and cons. Please hit the like, subscribe and comment on what are your opinions on different REITs as well. In periods where markets are red, it actually provides opportunities to look at some valuable stocks and REITs to buy. So Keppel DC Reit has been one of the rare only data centers and one of the rare REITs to be still increasing their DPU, thus making it one of the unique ones to be able to increase their DPU while the interest rate is still rising. Being one of the oldest REIT, it still has a lot of exciting things going in recent years. Although there are fears of drop in demands for data centers, I feel that it's not something to be worried more, as more and more technologies will require more cloud storages, therefore requiring data centers to be able to store all these data. So in today's market, at the current share price of about $2.08, with a dividend yield is about 5% when we use the latest second half distribution of 5.165 cents. Okay, so let us take a look at their key highlights. So as you can see from the financial results, the distributable income and DPU for second half of 2022 increased by 7.3% and 4.8% year over year, thus allowing them to increase their DPUs for the final distribution. Moreover, they also have a favorable debt profile with only bulk of the debt expiring from 2026 and beyond. So this is a way of telling us that the REITs do not have to refinance for these next 2 years, thus allowing their interest rate or their cost of debt to maintain or stabilize at a certain level. Moreover, they also have 74% of their loans fixed with local currencies hedged to mitigate on the currency fluctuations. Okay, so looking at their results, the DPU came in for the full year is at 10.214% when you include the second half of 5.165 cents, which is an increase of 3.7% year over year, with an attractive yield of 5.8% at the time when they announced the result at $1.77. So imagine the difference now, where the current share price will only give you a dividend yield of 5%, whereas compared to previously when it was worth $1.77, it was at a very high yield of 5.8%. The occupancy and the WALE is at healthy levels of 98.5% and 8.4 years for the tenancy. Moreover, the leverage is at also a healthy level of 36.4%, with cost of debt at a very low level of 2.2% as compared to other REITs, and a very high interest coverage ratio of 7.6 times, whereas compared to most of the REITs, because due to the increase in interest rate and the decrease in property assets, their interest coverage ratio is much lower, and for Keppel DC is still at a very high value. Okay, so now let's take a look at their results. So they have high distributable income and DPU due to additional assets, improvement of assets, and another extra data center that was being purchased. However, what I want to focus on in this balance sheet is not only about the revenue, which increased by 4.3%, but also because of the property expenses that is actually slowing down in the rate of increase. As you can see from the second half, is at a expenses of 12,472. However, if we compare with the Q3, it's at 6235. When we deduct it from this value of 12,472, you'll get 6237, which is 6,237. And this actually shows that the property expenses is actually stabilizing, and this is a good thing because the management has been time and time again saying about how they are trying to mitigate the increase in the expenses to themselves and passing on to the tenants. So this in a way actually benefits the REIT and allows the NPI to increase over time, and thus this will definitely benefit the shareholders in the long run. So another major contributor is from the finance income that was due to the netco bonds and the coupon income from the upcoming data center in China. So as you know, netco bond was a bond that was purchased from M1, which is their subsidiary, Keppel subsidiary, and it provides a very good coupon rate of 9.9+%. And this has been improving, as you can see, from Q3, it increased from 2416 to this current quarter of 2718. So this is quite a remarkable thing that is happening, and we will expect this data center to be ready soon and will further provide an improvement to their incomes. Moreover, this data center has already been secured with a lease of 15 years by a company called Blue Lease. So this additional asset will surely help to pump out the income. So looking at their tenancy, the lease expiring for the next few years is quite low, with lettable area at 4.6, 5.5, and only at 2025 there will be a larger value at 26.4%. So we will have to observe this from time to time again to ensure that they are able to release the thing to actually shows that the demand for data center is actually not dropping. If the occupancy starts dropping, then this might be a concern that a lot of people are flagging out. So there's one thing that the management has been very successful with is to fix the electricity tariff for Singapore co-locations assets for 2 years, whereas for Australia assets, they have actually fixed it till December of 23. So this is a good thing because it helps to ensure that the property expenses do not rise as the electricity cost rises, which we should expect it to continue gradually rising before actually decreasing maybe down the next few years. So this is one of the reasons why Keppel DC Reit has been very well in managing their property expenses. This actually in turn helps to benefit the shareholders by giving them a higher distribution. For their tenant base, there's not much changes between the co-location, the shell and core, and the fully fitted. So you can look up to my previous video or my first video with regards to Keppel DC Reit to know more about what is the different types of contracts and what are the benefits and the cons of them. So for their debt wise, as you can see, there's only a bulk that is required to be renewed at 2026 and beyond, with minimal values to renew for the next few years, or the debts to refinance for the next few years. So this is a good thing because the interest is expected to start decreasing by 2024. So this indirectly actually means that Keppel DC Reit is actually stabilizing, with the cost of debt not expected to increase so much as time passes. However, the interest rate will definitely affect it because of the hedging that is done at 70+%. But in my opinion, I feel that Keppel DC Reit will be able to manage it well with the high interest coverage ratio, and Keppel DC Reit is not immune to the interest rate. As you can see, the interest rate coverage ratio has dropped from 8.5 times to 7.6 times. So this is something to take note of, similar to other REITs that have a higher leverage and a lower ICR, and they have to be careful such that they do not actually hit the limit, which is at leverage ratio of 50% and at least interest coverage ratio of 2 times. So with regards to the concern demands for data centers, in my opinion, there is quite a minimal thing to be worried about. It's more of, is there any enough supplies for data centers? Because of the recent rise in AI and a lot of technologies improving, more and more data centers are actually required. So as you can see from this article, one of the main concerns is the slow growth in data centers due to a limit of land and power. And especially if you follow the news for US and Europe, there's a lot of restrictions or a lot of delays in the construction due to the limitation in various reasons such as powers and manpower as well, and supply issues. This has caused a longer delivery timelines and Thus, not a lot of data centers are being produced. So in a way, this actually helps to benefit Keppel data center in a way that there is lesser supplies and more demand. Thus, they are able to lease out at a higher rate, thus giving a higher income. However, we will also have to take note that to ensure that the management are able to do that. Moreover, if you see one of the CEO from Data Center Hawk, although we can take it with a pinch of salt, but if it's true, they have said that the challenge historically was that is there any enough demands for data centers? But now it has been flipped to whether is there any enough supplies to meet the demand. So this is one of the good things, and of course we have to look at the data more or follow them to ensure that this demand concern is not there, but rather it's a supply constraint with a huge demand. Thus, this benefits Keppel DC Reit in the long run. So Keppel DC Reit so far has been doing well in my opinion. As you can see from the results, they are actually doing what they are saying, such as reducing their property expenses through the hedging of the utility bills to the tenants. Moreover, they are also still maintaining a very healthy occupancy rate at 98.5% with high CR and a healthy leverage, and with a increasing of DPU. So all these factors are actually ensuring that Keppel DC Reit is a very good REIT to or safe REIT to invest in. However, do take note that the share price also plays a huge part, with the announced share price at $1.77 at the time when they created this slide. It was at a dividend attractive yield of 5.8%, whereas at the share price of currently, it's only at a dividend yield of 5%. So the timing of buying REITs might also affect the yield that you will get. However, if you are happy with 5%, then this share price is a good time to buy. Of course, this is just my opinion. I hope that you will do your due diligence to make the correct investment choices. Investing safe and correctly will be able to benefit you in the long run as compound interest takes into effect. Thank you so much for watching. You can also refer back to my previous video with regards to Keppel DC Reit, where I dive more on the different types of assets and their benefits and cons. Please hit the like, subscribe, and comment on what are your opinions with regards to the data center concerns, and if you have any other analysis that you would like me to work on next. Thank you so much for watching, and I'll see you in the next video.